Right now, we want to bring in Ed Yardeni. He is the president of Yardeni Research. And Ed, I know that you've been watching all of this, and your biggest concern at this point still is what's happening with the financials. What do you think about what you're hearing this morning out of Europe?
I can't say there's anything good coming out of Europe, that's for sure. And the issue here is a lot of investors lived through and recall the pain of the great financial crisis back in 2007, 8, 2009. The problem with that memory is that there's a sense of deja vu here all over again. This time, the epicenter of the banking issues seems to be in Europe. I don't know that the European banks ever really recovered from the great financial crisis, or they didn't really recover as well as the American banks did. So right now, I think their issues are becoming our issues in some ways. But I think our banking sector is in far better shape than theirs.
What's wrong with their banking sector, their big banks? What did they not do?
What
did they do?
Yeah, well, first and foremost, I think it's important to recognize that the banks are much more important to the credit markets over there than they are over here. Here we have a very vibrant, very robust capital market, and that supports the banking system and also means that we are less dependent on the banking system. We're in Europe, the banks are much more important in the lending markets than they are over here. And I think the real problem is what the central bank did over there. The ECB provided negative interest rates, which forced a lot of these banks to buy these securities at negative interest rates. So now as interest rates have gone up, they have large losses, as do we in our banks, but they don't have to realize them. As long as they don't have to realize them, that's not an issue. The question over in Europe is whether there'll be more pressure on the banks to realize them, in which case the ECB may have to back off of its aggressive tightening.
So we have risk-weighted capital, Ed. So I don't know if these numbers include that. They don't have enough community banks, small banks. They're more dependent, I guess, over there on just a few. But
correct.
Reportedly, your banks had an average capital ratio of 165%, U.S. an average ratio of 118%. So their banks are much better capitalized. Why? What is that? Are those not apples and oranges to compare those two?
Yeah, with accounting for capital is always an interesting exercise, and now there's issues being raised with these held to maturity securities. So no, I think the problem over there is their economy is just not as diversified, is not as strong as our economy is. For example, look at the way the markets behaved here recently. We've seen that suddenly the mega cap 8 technology companies have done extremely well and have provided an offset to the financials. Usually when the financials are taking a dive, that's not a good environment for stocks generally. But as we've seen in the United States, we've got some offsets here with people wanting to invest in the U.S. and finding that technology is, believe it or not, a safe haven relative to the financials. Over there isn't that kind of diversification. Their financials are much more important in their credit markets. They're much more important in their stock markets. And so it's, I think, one thing kind of leads to another. People are going to start to have some questions about some of the loan quality of European banks because their economy is just a weaker.
That 165% could be not mark to market, right? The marks could be, especially if it's not government securities, it could be nowhere near 165. It could be much lower than that.
The problem with banking, Joe, you're right. I mean, the problem with banking crises is you never know what's under the carpet until you lift the carpet.
Goes out. See who's naked.
I like the carpet example better.
Okay. Yeah.
The carpet. And just very quickly, what does the ECB, aside from stopping hiking interest rates, can they do some of the same things the Fed has done here, like open the discount window and say that you can borrow? Yeah,
absolutely. I mean, one thing that central banks have learned to do very well is create liquidity facilities overnight. Look how quickly the Fed last Sunday came up with a banking liquidity facility. So I think they are going to focus increasingly on financial stability and less on inflation. Hopefully, inflation will take care of itself. And by the way, these banking crises do mean slower economies, which do in turn mean downward pressure on inflation. So I think they can kind of let the liquidity crisis take care of the inflation side while they, put everything, all the resources on dealing with the financial crisis. And that'll mean liquidity facilities.
Ed, thank you.
Thank you.
Haven't seen you.